Okay, hello and welcome to another tutorial video. As you can see, we are going to go through a venture capital case study right here. I'm going to explain what you should expect in venture capital interviews and how to review information and make a quick investment recommendation. So lately, everyone wants to talk about AI, artificial intelligence, and whether it will replace humans, entire departments at companies, destroy humanity, and so on. And at the same time, a lot of people still want to get into venture capital, even though the market obviously isn't doing great recently. So I thought we could combine both topics here and discuss an AI startup in this case study. So we're going to cover here a short example of a VC case study that you might receive in an actual interview. It's based on a fake company called PitchBookGPT that automates banking style presentations and pitch books and speeds up the work that an analyst has to do at a bank. For all the files and resources here, you'll want to go to mergersandacquisitions.com/venture-capital-case-study. I'll link to it right below the video as well. This is a short summary and a short version of this entire case study from our new venture capital and growth equity modeling course. I'll also say that for this case study, you really want to go through the files here because, for example, we actually have an entire pitch deck for this company, PitchBookGPT. So you'll want to go through this and take a look at everything here. And then I also strongly recommend at least looking at the short case study file itself and then eventually going in and looking at our solution file as well. So there are quite a few documents here, and I recommend looking at all of them before you even go through the rest of this video. In this tutorial, I'm going to explain what to generally expect in VC case studies first. Then we'll go through what venture capitalists want in early stage investments. We'll look at the numbers and the math for PitchBookGPT and see if the valuation and the eventual market size and potential of the company makes sense. Then we'll go through the qualitative factors like the market, the product, and the team. We'll wrap up by giving a quick recommendation, yes or no, and then discussing the counterfactual, in other words, factors that might make us change our mind about this company. Let's go to part one and talk about what to expect in VC case studies in general. One option is that they could give you a cap table exercise where they describe a company's Series A, Series B, Series C funding, and then they ask you to plot the ownership in each round, and then maybe they give you an exit value and they ask you to determine how much goes to each investor group. Another option is that they could just give you a market, like real estate software or enterprise security software or something like that, and they could just ask you to get your thoughts on it and which companies you find interesting in the space and sort of go into a qualitative discussion like that. Another option is that they could give you a very simple startup financial model, such as a simple 3-statement model, and then ask you to complete it, or they could give you the historical financials or the customer information and ask for your quick thoughts on that. And then the last option is that they could give you a 1-page memo or 2-page memo or maybe a short pitch presentation and then ask you to read it and say yes or no. And that's what we're covering here. I would say for early stage venture capital interviews, this is by far the most common option. All these other options could potentially come up, but things like the financial models and the cap table exercises are a little bit more common in later stage VC case studies. Let's go to part two and talk about what VCs want in these early stage deals. Now, at the early stage, most of these companies have no revenue or minimal revenue, and they don't have free cash flow or EBITDA or profits or anything like that. So VCs are mostly evaluating companies based on their potential. So they might be small right now, but could they eventually serve a gigantic market and become billion-dollar companies or become worth even more, tens of billions or hundreds of billions of dollars? At a high level, in their early stage, they want to see that something like a 100x multiple is possible. Now, obviously, most startups are not going to come close to this. Most startups actually fail. And even though the ones that do succeed don't come close to getting a 100x multiple in most cases, but they want to see that the potential is there for this type of multiple. This company, PitchBookGPT, has an asking valuation in this round of funding of $20 million. You can see that actually on the first page of the pitch deck because they say right here that they are asking for $2 million in seed funding and a $20 million post-money valuation. So that is their asking price here, and that's going to determine everything else that we think and say about the company. And what it really means is that we need to evaluate if it can become worth $2 billion in the future, because 20 million times 100 is $2 billion. I have here a quick chart of what VCs at different stages are looking for, from the seed round to Series A to later stage. Generally, they want to see the potential for very high multiples in the seed round. Series A investors might be happy with a 10x multiple over maybe 5 years. Later stage investors might be happy with a 3, 4, 5x, or maybe even as low as a 2x multiple over the time frame of a couple years. So this is what they're generally looking for, and you have to keep this in mind with this type of seed stage investment. Let's go into the numbers for PitchBookGPT now. And again, I really recommend looking at the actual pitch deck for the company because you'll see what their business model is. You'll see why they think the product might be useful. The bottom line is that they're planning to charge companies $2,000 per month for uncapped usage and data for this product that automates parts of the pitchbook creation process. They have a case study here of one early customer, and then they have this market slide where they claim that there are about 4,000 banks worldwide and that therefore this gives them an addressable market of about $100 million if you go with these numbers and the monthly fees. If you do the math and you just take their numbers at face value, 4,000 banks, they're charging $2,000 a month, and there are 12 months in the year, then indeed 4,000 times 2,000 times 12 gives the company about 96 million in revenue if you do the math. So that part is true, but what's not said here is that they're not going to capture 100% of this market because no company ever captures 100% of any market, certainly not a $100 million market with thousands of firms in it. Maybe they can get to a small percentage, maybe they can get up to 10 to 20% or something like that. So if we just take the numbers here, let's say 10% of this and let's say 20% of this. Sure, we could see them getting to something like 10, 15, 20 million in revenue with this type of product. So I say right here, the eventual potential revenue is probably in the $10 to $20 million range, at least with the product that they have described here. The issue is that it's going to be very difficult to get to a $2 billion valuation here. We think even getting to a $1 billion valuation with this is going to be quite difficult. The reason is that most subscription software companies are valued based on a revenue multiple. Now, the numbers change over time, but if you look at them historically, they're usually in the range of about 5 to 10x revenue if you look at publicly traded subscription software companies or SaaS companies, software as a service. If you want to see some support for this, look at the file at the file and resource link that I provided before, and you'll see that for the most part, these companies are always sort of in this 5 to 10x range. Now, there are some deviations and variations. For example, in the COVID years, yes, some of them trading at much higher multiples, 20x, 25x, 30x, but right after that, they fell back down to that normal historical range of 5 to 10x. So if you think about what this means and you go back to Excel, if we have about $10 million of revenue and it's a 5x revenue multiple, this gives us a valuation of about 48 million. If we apply a 10x revenue multiple to 20 million in revenue, this gives us something closer to just under $200 million for the valuation. These are good outcomes. So if they started at, say, $20 million for the valuation, this is a great outcome for the company. They took something that was worth nothing. They raised money at $20 million, and then they eventually sold the company for $50 million, or maybe they sold it for $200 million, or they went public for $200 million, and they get to maybe a 2.5x to 10x multiple, something in that range. So it's a great outcome for the company, but the problem is that it's not really what seed stage VCs want for the most part. It's below what they're typically targeting in these deals. Now you might look at this and say, okay, but maybe they can get to much higher revenue if they charge higher prices, if they charge based on users rather than firms or something like that. And that brings us into part 4, the qualitative factors, the market, the product, and the team. The short answer is yes. Potentially, if they charge by user, they can get to a higher revenue level. So for example, maybe they could charge something like $1,000 per month per user. Maybe the average firm has 4 users who are going to use this product a lot. There's still 4,000 investment banks worldwide. There's still 12 months in the year. And so with these assumptions, let's just do the math here. Then yes, potentially, if they capture, say, 20% of this larger market, then yes, they could get to maybe more like 30 to 40 million in revenue or something like that. The issue is that once you start getting up to prices in this range, and once you get into something like, say, $100,000 per year or $200,000 per year for firms, the equation really changes. Because once you get up to this level, or even less than that, even something like $50,000 to $100,000 per year, at that level, a lot of firms are going to start comparing the cost of this service to an analyst's salary, bonus, and other expenses. And for a lot of these firms, they'll look at this and say, should we really spend $50,000 per year on this? Or should we just hire someone full-time who can do a lot of different things versus just pay this much money for a service that speeds up presentation creation? Yes, but it doesn't really do anything else that we need at our firm. The other issue here is that pitch books are not necessarily that important for the boutique banks that this company claims to be targeting. I have here a chart that shows sort of the no man's land problem for this company. The issue is that, yes, boutique and smaller banks are definitely easier to reach and sell to, but they're also less willing to spend money. And frankly, they don't care as much about productivity and efficiency because they don't depend on 100-page pitch books to win deals. Now, larger banks do care about efficiency. They do rely more on these long pitch books to win deals, but they're harder to sell to. They're also going to be far less willing to share their data and files with third parties, especially these very young early stage startups. So I think that is some of the problem here. It's a product that is useful to these large banks, but it's also going to be much harder to sell to these large banks, and it's going to be harder to get their sign-on to share their data so that they can actually use this service. Now, we have some other slides in the pitch presentation here. I'm not really going to go through them in detail, but they have something about their go-to-market strategy, the competition, the team. These are all fake people, by the way, so don't try to look them up. And then they have some more detail about how they're going to spend this money. So you can certainly go through all that. My short summary would be that the team seems fine. They do seem a bit junior, but they certainly have relevant experience. $2 million is a pretty reasonable size for a seed round. In fact, it actually seems a little bit low, but again, this depends on the market and how much product they currently have and what they need to finish. The use of funds here, if you go to slide 1 of the pitch deck, they have $800,000 for sales and marketing, $1 million on R&D, and $200,000 on administrative expenses. Overall, that's pretty reasonable, but the engineering spending might be a little bit low if you look at the numbers and think about the annual salaries and benefits here. I think the main issue really is that $2 million at a $20 million valuation for 10% ownership is quite aggressive for a seed round, and that is one of the key reasons why we are not in favor of this deal. And so that takes us into part 5, the recommendation and the counterfactual. Now again, I recommend going and looking at our full memo here because we do write a one-page memo provided on the site under the files and resources. But to summarize, we recommend against investing. We think a 100x multiple is highly unlikely. We think even a 10x multiple is going to be a stretch here. We don't think the market is big enough to support a $2 billion valuation or even a $1 billion valuation. We think that this company is probably going to be worth tens of millions or hundreds of millions if it even works out and they execute successfully. If they charge for per seat pricing, such as $1,000 per user per month, that might improve things a little bit. Probably still wouldn't get them to the 100x multiple level, but they might be able to boost it and they might get to, say, a 15, 20, or 30x multiple like this. If they were asking for a lower valuation, such as 5 or 10 million rather than 20 million, that would also improve the numbers and the multiples quite a bit. And then a third counterfactual is if they actually had a product that could replace analysts and associates and actually reduce banks' headcounts, and banks could save money like that, substantial amounts, hundreds of thousands, millions of dollars per year, then this might be more viable because then they could get out there and charge some very high prices to larger banks that wanted to use this. So that's it for our case study. To do a quick recap and summary now, I went over what to expect in VC case studies. You could get something more qualitative. You could get a model, a very simple model, a cap table exercise, but I would say this format, read about this company and say yes or no, is the most common one in early stage VC interviews. At a high level, in these very early stage investments, they really want to see companies that could potentially become worth 100 times what they're worth today. The multiple gets lower as you get later and later stage, but at the early stage, it's all about the potential, how big the market is, and whether this product actually makes sense for the customers. We went through the numbers for PitchBookGPT, and I have an Excel file here, a bit of a scratch file with some rough math on what the multiples and the revenue might look like. And then we went through the market, product, and team. And I think the biggest issue is that it's not really clear if they're targeting the right customer or if they have the right product for the right customer in this case. And then we recommended against investing, and we explained a few factors that might change our minds, such as tweaking the product somewhat, having different pricing, having a lower asking price in this funding round, and so on and so forth. That's it for our case study. Hopefully now you know a little bit more about what to expect in these types of VC case studies, especially at early stage firms.